Hello, I'm Rachel Jones for the Finance News Network. Joining me today from Laserbond is CEO Wayne Hooper. Wayne, welcome to FNN.
Thank you. Great to be here.
Now, first up, Wayne, could you start by giving us an introduction to your company?
We're in the business of making wearing components last longer for capital-intensive industries. Imagine these industries have equipment with components that wear out. We actually repair and reclaim those components, give them a longer life between maintenance cycles so that they can increase the productivity and uptime of their equipment. We have a range of technologies generically called surface engineering, which we use to increase the life of wearing components for a large range of industries.
Now, before we get to your results, can we talk about the opportunity for surface engineering applications and the size of the market?
The industries we deal with typically have equipment that's operating in severe environments. And this equipment is worth millions, tens of millions, even hundreds of millions. When it's out of service, it costs them a lot of money in terms of lost production. So what we're about is actually increasing the life of those weakest links in that equipment to make sure that they can increase the time that it's in production. That's where we deliver savings for our customers. So the market is actually huge. We have technology that is new, that applies high performance surfaces that haven't been able to be applied before, and it helps our customers reduce the costs of downtime and increase their productivity.
And now to your financial year 2018 results. What were the highlights, starting with financials?
Well, on the financial side, we had excellent growth last year. Revenue was up by 13.8%, and that was from our services and products division. So that 13.8% increase didn't include the technology sale. In the previous year, we had a technology sale. So overall, those divisions grew quite strongly. So that in turn delivered high profits to the organisation. We did have an impairment of some slow-moving stock. The board thought it was necessary or prudent to write down some stock. Doesn't mean it's been written off, it just means that we've taken an impairment on that. But after that impairment, which was a non-cash transaction, we had great profits and we increased our dividends by 20%.
And what can you tell me about your operations?
Our operations for the financial year work extremely well. We have had to invest in recruiting and training of new personnel because we have had exceptional growth, and that growth continues this year. So our numbers of employees are up by 40%. We've also invested in new equipment, and we continue to do that. So we are investing to deliver future growth.
Thanks, Wayne. And now to your strategy and share price. How is the strategy going and how are you progressing?
Well, our strategy is to actually grow the business both domestically through organic growth, and that's continuing very strongly. In this financial year alone, the first quarter of this financial year, we have revenue that is up 44% on the previous corresponding period, so excellent growth coming organically. We're also expanding internationally. We've got business development for our products to be exported around the world. Our OEM customers that are in the mining and minerals processing area and other areas, they're also growing strongly, so we're growing with them. So the growth is continuing. For our technology, we have a lot of interest from overseas in our technology and how we can help other companies through licensing. So we're exploring those opportunities as well. And in fact, very recently we announced that we have sold a technology license to a UK-based multinational engineering company. They see our technology as a way of differentiating their product, and that revenue will be recognised in the second half of this year. So growth this year is going to be fantastic and will continue.
And can you provide a comment on the share price?
Well, it's undervalued. I know we're a small cap, we're not on many people's radar, but the growth we're delivering is continuing and the share price can only go up, in my opinion.
And to the last question now, Wayne, what is the outlook for the financial year 2019 and why should investors consider adding Laserbond to their portfolios?
Well, as I mentioned, the outlook for 2019 is continuing very strong growth with the technology sale and organic growth that we've been achieving. The first quarter is a demonstration of that. So we've recently announced that increase in revenue for the first quarter, and we expect it to continue for the full financial year. With the technology sale, it's going to be a great year. In terms of the shares, we're a growth company, we're delivering strong growth, we've got a history of making good profits, and we've got a history of fully franked dividends, which we intend to continue. So why wouldn't you add it to your portfolio?
Wayne Hooper, thanks for the update.
Thanks for the opportunity, Rachel.